Hi guys, today we will be learning about credit history, credit scores, and credit reports. Our learning targets for today are I can explain why it is important to establish a positive credit history. I can describe the information in a credit report and how long it is retained. I can describe the value of credit reports to borrowers and lenders. First, let's talk about how to establish credit history. Your credit history includes information about how well you manage your money and pay your bills. To build a positive credit history, you must first obtain a small loan or begin buying on credit. Then you must make regular payments to repay your debt. Bankers and other lenders use this information to decide whether they should loan you money for large purchases, such as a car or a house. Landlords use your credit history to decide whether or not to rent an apartment or house to you. Let's look at some positive and negative factors that can affect our credit. A positive factor is low credit utilization. This means we're paying off most or all of our credit card balance monthly. On the other end is high credit utilization, meaning we're paying either none or just the minimum amount of our credit card balance monthly. This would be a negative factor for our credit. Another positive factor would be if we are repaying on loans that have been given to us. These could be student loans after we graduate college, or maybe we received a loan for starting a business or getting a car, and we're paying that back. A negative factor would be if we've recently lost our job and we're looking for work. A positive factor would be if our age of our credit years is high. This is calculated by taking the average of how long all your accounts have been opened. That average age of accounts is your credit age. So if you have one account that's been open for 12 years, your credit age would be 12 years. That would be a high credit age. A negative factor is if we have no open credit lines or our age of our credit years is very low, 0 to 2 years. When we're applying for a loan, it's always best to answer the questions on your loan application honestly, even those that might reflect poorly on past credit history. This would be a positive factor when applying for a loan. A negative factor might be if we've applied for multiple credit lines or loans in a short period of time, such as a house, a car, phone, multiple credit cards, multiple student loans. If you apply for more than 4 credit lines or loans in a 2-year time period, this can have a negative impact on your credit score. Another positive factor is making payments on time monthly. A negative factor would be if we make late payments. Whenever you make a late payment on a credit card or a loan, this can negatively impact your credit score. In this example, Roger's older brother has applied for a bank loan to buy a jet ski. Each statement below tells something about the brother's credit history. We need to decide whether the bank would regard each statement as a positive or negative factor in deciding whether to approve the loan application. The first one says that he pays the credit card balance monthly and on time. This would be a positive factor. The next one says he recently lost his job and is looking for work. This would be a negative factor in deciding whether or not he would be approved. He is currently repaying student loans and a loan to start a business. This would be a positive factor because he's proving that he can pay back debt. He answered all questions on the application honestly, even those that reflected poorly on his past credit history. This is a positive factor in deciding whether or not he would be approved. So, why is it important to have a good credit history? It's important to have a good credit history to be able to make large purchases, such as a house or a car. Next, we'll look at credit reports and what's included in a credit report. A credit report is a detailed breakdown of an individual's credit history prepared by a credit bureau. Credit bureaus collect financial information about individuals and create credit reports based on that information. Lenders then use the credit reports along with other details to determine a loan applicant's credit worthiness. Credit reports are compiled by agencies to help lenders decide whether or not to loan money to consumers. A credit report includes a person's personally identifiable information, credit accounts, credit inquiries, as well as public record and collections. It's important to remember that any negative information on a credit report, such as late payments, would stay on your credit report for 7 years. Credit reports should always be reviewed for errors. You should always verify that the information on your credit report is correct, so that lenders see the most accurate FICO scores when you apply for credit. If you find an error on your report, you should report it to the appropriate credit bureau. Let's take a look at the information that is provided in a credit report. The first category is personally identifiable information. Your name will appear on a credit report, your address, a social security number, your date of birth, and your employment information. The second category is your credit accounts with lenders. For each account, the type of account will be listed. Is it a credit card, a car loan, a mortgage? The date you opened the account will be listed. Your credit limit or loan amount will be listed. Any current account balance will be listed. And your payment history will also be listed, including if payments were made on time or late. The next category is credit inquiries. There are hard inquiries and soft inquiries. Hard inquiries are requests for credit lines or loans that you make. These are visible to lenders. So if you're applying to get a car loan or a mortgage loan, or if you want to open a new credit card, that would be a hard inquiry. You're giving that company permission to run your credit report. Hard inquiries remain on your credit report for about 2 years. Then there are soft inquiries. Soft inquiries are when lenders are looking at your report to send you a pre-approved credit offer or something similar. Since you are not authorizing this, this is only visible to you and would have no effect on your FICO credit score. The last category is public record and collections. If you have ever filed for bankruptcy, this would be listed on your credit report. Also, if you have overdue debt that's been sent to collections, this would be listed on your report as well. Now let's determine whether the information provided would be in a credit report or not. the highest balance and required monthly payment information for closed and open credit card accounts. This would be listed on a credit report. Checking and saving account balances. This is personal information and would not be listed on your credit report. Your credit score would be included in your credit report. Your payment history of all accounts open and closed, whether you made payments on time or not. This would be included in your credit report. Your employment history would also be included in your credit report under your personally identifiable information. Your income tax information can also be included in a credit report. Any recent credit increase in the past 2 years is also included in your credit report. Below is Christina's credit information. We will correctly sort her information and where it would go on her credit report. She lives at 4316 Woodland Road in Yellowstone, Texas. This is her address. So this would go in the personally identifiable information column in the middle. Her credit card has a 19 and 95/100% annual interest rate. This would go in the credit history column. She currently has a balance of $1,956 on her credit card. Since this is talking about her current balance, this again would go in the credit history column. Her social security number is 123456789. This is personally identifiable information and would go in the middle column. She has a checking account and savings account at Yellowstone Bank. This is talking about her personal bank accounts, so this is personal information and would go in the middle column. From 2010 to 2012, her annual earnings were $14,600, $15,800, and $18,000, working part-time at Egan's Grocery. This is employment information, so it would go in the first column. And last it says she was 1 week late on her May 2012 credit card payment. This has to do with her credit history, so it would go in the third column. Next, we'll learn about credit scores and how they are calculated. The information in your credit report is used to calculate a credit score. A good credit history will give you a high credit score. Late payments, high credit card balances, or owing a lot of money are likely to result in a low credit score. Lenders use credit scores to decide whether to give you a loan or a credit card. Your credit score can affect the interest rate you have to pay for a loan or a credit card. A standard credit score that is used in many lending decisions is called a FICO credit score. This is an example of the range of credit scores that you could receive on your credit report. FICO credit scores range from a score of 300 to 850. There are 5 main categories that your score could fall under: poor, fair, good, very good, or exceptional. The poor range is between a score of 300 and 579. If you receive a score between 580 and 669, your score would be considered fair. If your score is between 670 and 739, your score would be considered good. If your score is between 740 and 799, your score would be considered very good. And if your score is between 800 and 850, your score would be considered exceptional. It is the goal to receive a credit score of 850, and as you work to build your credit and make payments on time, your score will continue to improve. The higher your score, the lower the interest rate that you'll receive on a loan. FICO credit scores have been adopted by the 3 credit bureaus, Equifax, Experian, and TransUnion. We know that the scores range from 300 to 850. The allocation of what makes up your score is based on the following. 35% of your score is based on payment history. Do you make payments on time or are your payments late? 30% of your credit score is based on credit utilization. Are you paying off your account balances in full each month, or are we just paying the minimum payment required? If we pay off our account balance in full, we might receive a credit utilization of 0%. This would have a very positive impact on our credit score. If we don't pay off our account in full, the higher our credit utilization percentage, the more negatively impacted our credit score will be. 15% of our score is based on credit age. Remember that credit age is calculated by taking the average of how long all your accounts have been open. The average age of your accounts is called your credit age. 10% of your credit score is based on having a mix of credit. Do you have different credit types, such as credit cards, a mortgage, a car loan, maybe student loans? Having a mix of credit types can have a positive impact on your score. If you only have one credit card, your mix of credit would have a negative impact on your credit score. The last 10% that makes up your credit score is based on recent applications. How many hard inquiries do you have in the past 2 years? If you have multiple hard inquiries, this could have a negative impact on your credit score. If you only have 1 or 2 hard inquiries, maybe you've applied for a credit card and a student loan in the past 2 years, this would not have a big impact on your credit score. The table below shows 4 credit scores that are based on each person's credit history and the details of the car loans they were offered. In the first column is Mr. Wright. He has a credit score that is fair of 605. It says he has 27 open accounts. His credit utilization is 46%. He's missed 5 payments recently, and he has 10 hard credit inquiries. It says Mr. Wright was able to purchase a car for $32,000 with a down payment of $5,000. He got a 13.5% interest rate on his loan, and he has monthly payments of $916.25 for 36 months. Miss Jones, in the next column, has a very good credit score of 742. She has 24 open accounts. Her credit utilization is only 13%. She has missed 0 payments recently, and she only has 2 hard credit inquiries on her account. Mrs. Jones was able to purchase a car for again $32,000, but this time with no down payment, meaning she didn't have to pay any money up front. And she got a 2 99/100% interest rate on her loan, which is much better than Mr. Wright's. She has monthly payments of $574.86 for 60 months. Mr. Martinez has a good credit score of 674. He has 21 open accounts. His credit utilization is 24%. He's missed one payment recently, and he has 0 hard credit inquiries on his account. Mr. Martinez was able to purchase a car for the same amount, $32,000. The dealership required him to pay a $1,000 down payment, money up front, and offered him an interest rate of 6.5%. He has monthly payments of $606.55 for 60 months. Miss Yang has an exceptional credit score of 810. She has 13 open accounts. Her credit utilization is 14%. She's missed 0 payments recently and only has 1 hard credit inquiry on her account. Miss Yang was able to purchase a car for the same amount, $32,000, with no down payment, no money up front, and she got a 1 75/100% interest rate on her loan. She has a monthly payment of $557.40 for 60 months. Take a minute to compare each of these scenarios and determine why it is important to establish a positive credit history. Look at the differences in their score, their open accounts, credit utilizations, missed payments, credit inquiries, if they had to pay a down payment, what their interest rate was, and compare their monthly payments. The 2 higher credit scores of 742 and 810 both did not have to pay a down payment. Miss Jones and Miss Yang also had the lowest interest rates of anybody else. They also had a much lower monthly payment as well. It's important to establish a positive credit history to be able to get lower interest rates and monthly payments on big purchases, such as a car. Last, we'll talk about the credit bureaus. In the U.S., there are 3 national credit bureaus: Equifax, Experian, and TransUnion, that compete to capture, update, and store credit histories on most U.S. consumers. Now you will complete 2 independent practices on your own. In each activity, you will be the credit counselor for 3 different people, help them determine what their FICO credit score is, and then help make suggestions on how they can improve their credit score. In the second activity, you will figure out the impact those credit scores will have on getting a car or a mortgage loan. Remember to ask for help if you have questions.